how much is the intrinsic value of my portfolio as opposed to the market value? And that's a differential. If you start thinking like that, you'll sleep nights, even when you don't.
Welcome back to another episode of Get Your Fill, Financial Independence and Long Life, where we explore ways to achieve those two goals. And people come on to help us who are experts in those exact categories. And that's why I'm very excited that Steve Selengut is with us today. Steve is the author of 2 investment books, Retirement Income Independence Coach, and a 40-plus year seasoned investor. He will show you how to make stock market volatility your very best friend. Steve, thank you so much for being with us today.
My pleasure.
So,
Good to be
Steve,
here.
I have a question for you to get us started.
Okay.
How much in your pocket realized income does your investment portfolio produce? And is the amount growing every quarter and every year?
That is precisely the question I like to ask people when I talk to them for the first time. And I can tell you that my portfolios, all 3 of them, are yielding over 10% on market value from a diversified portfolio that probably contains any security the people in your audience have heard of, from the Nasdaq technology stocks, all the popular ones, to your oil companies, your drug companies, all the equities, and the bonds and preferred stocks and notes and mortgages and stuff like that, those companies and others use to fund their operation. The income is produced by both sides. Most people don't think of the stock market as the place to look for income. Well, there are mutual funds. And of course, mutual funds contain all kinds of stocks. Go a little bit further, mutual funds are called open-ended funds. And that simply means that there's an unlimited number of shares that they can give to the public when somebody wants to buy them. They take those shares back when people sell them back to the fund, like they normally do during panic situations. Closed-end funds are very similar. They own exactly the same securities, maybe a bigger variety than the mutual funds do, but they have a fixed number of shares, and that's why they're called closed-end. They're not called closed-end because they're closed to new investors. They're closed-ends because they're just like stocks on the exchange. If you go out and buy 100 shares of Exxon, you're buying an ownership interest in that company. If you buy 100 shares of a closed-end fund that owns 250 companies, you're buying shares of the trust that runs those funds or manages it. So it's very similar. It's the same securities we're talking about, but we have instant diversification. And instant diversification was the key element that made mutual funds so popular in the first place. Back in the 1800s sometime, they were invented back then, but nobody was using them so much. And closed-end funds had been invented, I think, in Europe about 20 years before that. But they didn't become popular until after the Great Depression, when the individual investor pretty much got knocked out of the stock market and became afraid of the stock market.
Yeah, they figured out they weren't able to time the market the way they thought they could.
Yeah, they couldn't time it, or just couldn't deal with the image of people jumping out of windows as their companies went bankrupt,
Yeah.
and saying, no, I'd rather start my own business than trust somebody else to run a company well enough to make me a wealthy person.
Yeah.
So mutual funds came to say, okay, we can let you own all those great companies a little bit at a time in this pot, which is professionally managed. So that's the principle that brought mutual funds to life. We're going to let you get back into the market so you can participate in the growth of the American economy, the world economy, even through mutual funds. Closed-end funds are exactly the same thing. They were invented sooner, but they contain the same securities. The key element, though, is that they operate as a pass-through trust. And I don't know if people my age already know about trusts, because you have to set them up for your kids and for things like that. Well, a pass-through trust is one where all the income that comes in from dividends or interest, not at least 95% of that has to go back out to the shareholders. Now, can you imagine if Amazon paid its shareholders 90% of its profits? I mean, think of how well off everybody would be. Of course, then they wouldn't be as big as they are now, because they wouldn't have been able to reinvest their income, which is what their intention is to doing. So,
Yeah.
so you grow with Amazon because they're growing and the shares become more valuable as the company grows in its worth. But you also have to put up with the idea that when we have a correction like we've had, and I really don't track individual stocks, so I don't know how well or poorly Amazon's done over the past 2 years. The S&P is still down 10%, and the Nasdaq's down almost 20%. So I'm assuming that Amazon's not doing so well over the last 2 years. But on the other hand, and this is where that money comes that we were talking to at first, closed-end funds that contain Amazon and all this are still paying out, even though their prices are down too, of course, they're still paying out 7, 8, 9% to their shareholders. So that's the big difference. So when you ask me how much money, how much interest, and I say 10%, when you think of, I call it a universe of this type of security, both equity and fixed income, all of which are passing through to their shareholders distributions ranging from 7% to above 10%, you can see why you can develop a portfolio that's very well diversified, that's still paying much more income than the average person thinks about. Why haven't they ever heard of closed-end funds? Christine, you've heard of closed-end funds. You must have from all the people you've interviewed. But
Yeah, but I don't think people have a good understanding of
no,
some
I
of the
don't.
nuances of closed-end funds.
And there are a lot of nuances and there are a lot of differences. But the prominent feature is this distribution element. And most of them, particularly the income variety, the one that owns stock, bonds and preferred stocks, they typically pay monthly. So even if you have a portfolio like they have containing 300 or 400 municipal bonds that only pay semi-annually, they're still paying their shareholders monthly. So you can you can develop that type of portfolio that they taught you about in your economics class, that you want to have the same amount of income coming in all the time. You don't want it all coming in June, because then what do you do for the next 5 months until the December money comes in? Well, these things clear that up for you because they pay it mostly monthly. On the equity side, about 2/3 of the equity base, and when I mean equity, I mean stocks. Stock market is equity. It's equity ownership of companies. That's how it gets the name. They typically mostly pay monthly, but maybe a third of them pay quarterly. And I avoid any that don't pay at least quarterly. And there's so many out there. There are maybe 450 of this type of security, comparing with just add a 0 or 2 for the number of ETFs and mutual funds there are and stocks. But there are around 200 that meet what I call my quality criteria. I could go into them, but I don't know. You must have some questions for me. So
Yeah, let's start with just helping people understand some of the differences between a closed-end fund and a mutual fund from the perspective of, for example, fees. I mean, that's one of my objections to mutual funds, is that they tend to have high management fees. How would these compare to that?
okay, the difference is that mutual funds actually have lower on the surface fees, particularly Vanguard and some of the ones that you'll find in 401ks, which is pretty much where most people get introduced to investing. Vanguard has very low funds, and they keep their funds low so that they can be eligible to be in 401ks. The higher fee mutual funds that you're talking about, probably Vanguard probably has a lot of them too, but they don't find their way into 401ks because 401ks have restrictions on the fees that the manager can collect. And you won't find any closed-end funds in them because the fees are higher in closed-end funds than they are in mutual funds or ETFs for that matter, which are the lowest
Yeah.
fee entity. But the good thing about them is that you and I, as owners of a closed-end fund, we don't pay those fees. So the yields that I was talking about, the 8 to 10 and better percent, that's after fees. The closed-end fund managers, they get a fee from the fund's operation. That's one cost. The other cost they have, and I can't really talk about closed-end funds without talking about a thing called leverage. which when all of your listeners run off to their advisors to ask them about closed-end funds, they're going to say, oh, they use leverage. You don't want them. Well, the counter is, what is leverage? Leverage is borrowing money, not it's using other people, just like we do when we buy a home. We borrow money from the bank.
Mm-hmm.
That's leverage. It allows us to leverage our own wealth, our own prospects, our own salaries by being a good prospect for them to loan money to and not lose it. And it's the same thing that all companies do. Anybody's in businesses today, and a lot of people who aren't equity businesses like the oil companies and the big companies, they all borrow money. If
Mm-hmm.
I need to build a new plant in the South, got to borrow money to build that plant. And I'm using that to do construction. Now, on the other hand, we're not going out and buying cars or buildings or stuff like that, or paying salaries for that matter. We're going out, and what we're doing with our leverage is we're borrowing money. Right now, let's say we're borrowing money at 5%. So what we have to do is we have to go out and find investments with that are paying us more than 5%.
Mm-hmm.
It's more difficult, and I shouldn't, when you talk about the inverted yield curve we have today, it's more difficult. You have to be a little more creative, I guess, to find long-term rates that are higher than your short-term rates. If I'm going to borrow money at 5% and I can't reinvest it at greater than 5%, I'm not going to borrow it in the first place. So I'm not going to use leverage unless it actually is leverage, meaning that it produces more than it costs. Think about the last 12 years since the financial crisis, when interest rates went from 5%, where they are right now, to almost zero. Think about all these managers who are investing all this money at very low percent, not getting a lot, but if you're investing at 1% and getting 3%, that's 3 times, right?
Yeah.
So that's not too shabby an investment. If you have a large home and you're my age and the mortgage has been going down for years, right? And the value in your house, like everybody's has been going up for years, all of a sudden you have a very small mortgage and a very large value that this guy over here says he'll let you borrow $100,000 at 2.5%. And you look over here and you've got this desk full of push buttons you can push to buy closed-end funds that are yielding 7 and 8%, 3%, 7%. Sounds like a good investment to me. So that's the nature of what we're talking about. So all these funds that we have, and this is on the income side, have been struggling to invest money at 3% for 10 years. But they've been buying bonds, hundreds of them, all with different maturities. 10 years into a 15-year mortgage or a 15-year-old note or borrowing, or 10 years in, what happens? Even though the bond is got a lower market value, it still has to pay its face value to whoever bought it. Here we are, we're now at a 5% rate. These guys are getting back their money from bonds and things they invested at that were paying 3%, and they can take that money and now invest at 5%. So even in an environment like this where the market's down and interest rates are up, these guys have the opportunity to increase the amount of income their funds are producing. So they have no trouble at all maintaining their distributions to clients in a higher interest rate market. The
So
only
system.
difficulty they had in this one, because it went up from 0 to 5% in a year, like a 500% or more
Yeah.
increase. That's typical because the maturities aren't as fast as that.
Yeah.
So there's a little bit of hiatus there where in order to keep their distributions equal, they may have had to return some capital here and there, but it's generally negligible and doesn't last for a long time, and it's not coming out of your pocket, because any return of capital, and return of capital is the second thing that the financials guy is going to tell you about. Oh no, they return your own money to you. Every penny that they return to you reduces your cost basis, so it's a wash. And And the comeback I have for that is if I own somebody's mortgage and they're paying me every month, they're paying me back principal. And the annuities you're selling to your clients, how are they paying that money? They're paying back the principal. It's return of capital, man. And return of capital is not a dirty word, and neither is leverage. So,
No, absolutely not. In the real
so
estate
that's
world, we
how,
love leverage.
that's the real substantive difference between the closed-end fund vehicle and the either the ETF or the mutual fund. There's one other difference, and it's really not a it's not so much a difference between the closed-end funds and the others as there's a similarity between a closed-end fund and a common stock. Common stocks do not sell at their net asset value. They sell at a market value that's totally non-related. You get a new issue. Look at the new issues during the dot-com bubble. The the, the radio announcers, the journalists, all the speakers, they're actually speaking about the no value market. None of these companies had ever made $1 of profit, and they're selling for hundreds of dollars a share. The price of a common stock is not tied to its book value. Neither is the net asset value of a closed end fund tied to the price of the stock that you can buy. There's no intention for it to be the same. No efforts are made. They don't buy back shares. They don't sell additional shares to do that. No effort at all is made to make the price equal to the net asset value. But people get really hung up on net asset value. My own clients used to get hung up on net asset value. The people in our closed end funds discussion groups on Facebook always are talking about it's selling at a premium. It's selling at a discount because they're so used to the idea that net asset value is the same as the price of the ETF and the same as the price of the mutual fund. That's the major differences. That's what closed-end funds are all about. Their purpose is to send out income to their share owners. That's why they exist. They don't have a price range that goes from $30 in a down market to $300 in a bull market. They have a price range between maybe 5 and 15 or 10 and 20. And that's it. You're not going to see them move out of that range because they're only getting 5% of their net earnings back that they can reinvest. The rest of it, they're given to you and me. You can't grow the market value. You can't grow the number of factories if you're not reinvesting the money like a normal business would. And that's what's the stock market and the ETFs are. They're just looking at that basic equity function, build the market value, build the market presence. CEFs don't care about that. They want those guys to do that because that's what produces rallies, and then they can sell things at profit. Okay, so that's about as much as I can tell you about the difference between closed-end funds. And I don't think I expressed it quite the same way in the book, but the book. I have a
Book.
book.
Ah, there's
Yeah.
the book. Yay. Retirement
Retirement
Money
Money
Secrets.
Secrets. It's not selling you and trying to get you away from your investment advisor in any way, shape, or form. All it's telling you is to be aware of this type of security where when you're getting close to retirement or in retirement and your advisor is saying, well, we know you're going to start to remove 4% a year, and they're talking about 4% of your market value.
Right.
And if you keep the same amount these days, it's more than 4% because the market's down. But where's it coming from? Where's it coming from? So the next question, or the first question that all of you listening to this should be asking yourself is, how much income in my pocket income that I could reach in to my portfolio, take it out, put it in my pocket, and go to do a safari in Africa? How much money do I have that I can spend? And you're going to be surprised at how small that number is. If it's 3%, you're in a good position, relatively speaking. I've taken over a portfolio. I've been managing other people's money since 1979. Rarely, if ever, did I look at a portfolio that was already generating more than 3% in income. Rarely, very rarely. In the later part, after I started writing articles and things on closed-end funds, I'd get some new clients that had already started investing in them. And then, then there was some that would surprise me with the money. And lately, when I look at a portfolio to review it for a person and they're in closed-end funds, I find a lot of people are learning how to get more money for themselves, do-it-yourselfers, mostly. And they're the ones that'll have the easiest time converting or getting their feet wet in this type of security. Because I certainly don't recommend that anyone go out and sell anything to go buy a bunch of these closed-end funds. That's not the way you do. That's not the way you run your investment portfolio.
One of the reasons, or one of the things I didn't like about investing in mutual funds as a younger person is that I didn't hold them in my retirement account. So the fund might be going down and I'm still getting hit on my income tax every year because something they sold made a profit. Is that, are closed-end funds something that would have the same issue where you really want to hold it in an IRA or something?
And yes, the tax implications are exactly the same. The money you receive is going to be either taxed as regular income or as capital gains, long-term capital gains. It could be long-term capital gains, short-term capital gains, dividends, interest. Return of capital is tax-free. Remember, we talked about return of capital before when you're deducting it from your cost basis. There's no tax on that. So if you're in a very, very high tax bracket, you might want to just keep this type of investment in your regular IRA. It's a wonderful thing for Roth IRAs because it's tax-free. Today, a person could create a portfolio yielding 10% in a diversified portfolio of diversified portfolios and be making 10% in a Roth, and almost never having to touch it until they really need it. Yeah, that's really something to think about. But I use it in my own account, in my personal account as well. And I say, okay, I'll pay the taxes because if I'm making 10% and I'm paying, even if I'm paying 30%, I'm still netting 7%. And I can't net 7% in more than a handful of mutual funds that I know of and maybe 20 ETFs. And then that's taxable too. So that's not really a proper comparison. Right. So yeah, depending on your tax bracket is where you put which securities. In the long run, you're going to pay on every dollar that's in your IRA anyway. I mean, I'm taking my RMD right now and it's coming out and I'm paying taxes on it and my Social Security and the rest is just what I earn in my portfolio and the minuscule amount of money I make in my new venture of being an income coach and stuff like that. But that's just getting started, and I'm really doing it more to keep me busy than anything else. At this age.
So how did you first get turned on to the closed-end funds?
The first closed-end funds I got involved in were probably about 25 years ago. And it was the municipal bonds that really excited me because for my wealthier clients, I was buying individual municipal bonds.
Yeah.
In fact, my first fixed income investment I ever made was in the 1970s when I bought Fort Pierce, Florida municipal bond for myself with the profits I had made from my first stock market transaction, which was Royal Dutch Shell at the time, or Royal Dutch. It was just Royal Dutch back then. And I sold that. I took the profits and my broker, I said, why don't you put that in a tax-free investment for your future? And that's what we did. And I held that thing until it matured. The thing about buying used bonds and used mortgages and things like that, there's a markup that you have attached to them that you don't see. And it's really like 2% or 3%. So if I were going out and buying a corporate bond or a municipal bond for one of my clients, there'd be a 2% or 2 to 3% markup in addition to what it was worth based on where market value was compared to par. So, And then when they went up in price and you said, oh man, I can take a profit here. When the reality of it was, if you gave back 3% to the broker, your profit wasn't going to be a whole lot at all because they don't go quite as much. They don't run crazy like stock. I got tired of that. I don't remember how I discovered, but I guess it was probably because I had this one or two closed-end funds that I was using in equities. One was called thing at the time, it was called Petroleum and Resources. And what it did, it was just the energy sector, which has always been a great place to be. And I used to do it in the individual side, particularly. I mean, I educated my son from selling stocks and the in the energy sector. But this one was unique. It paid a very small dividend 3 times a year. And at the end of the year, it paid like, if it was paying 10 cents a share for the whole year, then it paid $2.98 a share in December. So I owned some of that. And if I could get a profit on it, I'd sell it. And then I'd start buying it back in September because I knew they were going to give me this enormous. I read a little bit about it. And I guess I read the words closed end fund and I looked at it and I looked online and I saw that there were other closed end funds and that they've been around a long time. And some of them are paying out 5 and 6, 7 and 8%. So I started to dabble in them. And I particularly noticed that there were municipal bonds and bond closed end funds that you could buy. You get the dividends. You could buy and sell them just like stocks, and there are no markups. So if any of you out there have a portfolio of bonds or treasuries or any of these things where you have trouble selling them if you want to at a profit because of the markups, closed end bond funds are it's nirvana. I mean, it's who would have thought of such a thing? So I started doing a lot of municipal bonds for my clients and for myself. Today's municipal bonds, they suffered the most from this severe drop or from this severe rise in interest rates because they don't have as diversified a package. It's a one sector fund.
Yeah.
So even though they're not as risky technically, meaning the municipalities can always raise taxes, they're not going to go out of business. It's a little more risky because of its single sector approach. Today, you can put together a portfolio of 40, maybe more. I understand a few of them have started to raise their distributions again. They lowered their distributions this past year a lot. That you can put together a portfolio of municipal CEFs that are yielding close to 5%. 40 of them are yielding over 4% as of my last study of that. I haven't been using a whole lot of them recently because I'm only doing my own thing now. I'm not investing for anybody else. But I've been in the groups. I've been cautioning people that they were doing a lot of distribution cutting, and they should be patient and wait until those maturities that we talked about early start getting into the mix. They're now investing at 5% instead of 2%, and they'll start to raise their dividends again. So that's where they should be. Those things, if you're a very high tax bracket, put them in your individual account. Don't waste your money putting them into the Roth or into the IRA because there are so many much higher yielding taxables you can use in those places. On the other hand, they are really a lower risk in the long run than anything other than government bonds, other than federal government bonds. So they, in a very large portfolio, up in that, 10 oxygen level area that some of us are in, not me, but others. And if they're in a tax bracket where 4% is a big deal, fine, go for it.
You said that people shouldn't sell something they already have to buy these funds. So when do you recommend that people start their investments
I mean,
into
they
the
shouldn't go
closed-end
right
fund?
out because somebody like me starts telling them that they can do something better. They shouldn't run out and sell ever. If you have a tip, you don't sell and go do that. You got to study this stuff. You got to do research.
Yeah.
It's your money. and the other people are trying to get it. So don't listen, you know, check me out thoroughly. You've never heard of me before. Read the book, read my articles, look around. But anyway, in any of those situations, this is an ideal time to switch between securities that are down in price and paying a low level of income to a group of securities that are down in price and paying a great deal of income. When you realize, let's say, the company that you worked for all your life and you've got thousands of shares of their stock and it's down right now and you love them to death. But even though it's a large sum of money, maybe every quarter, it's still only 2% or 3%, even at today's market value. Even if it's 4%, you can still own that company in a closed-end fund along with 250 other companies, and it's paying 9%. Sell this one, capital loss. The government loves you for taking losses or allows you to benefit from taking losses, but it punishes you for taking profits. That's our government. You can take that loss, you can get the government's benefit, but you can immediately put it into something. And this wonderful thing, particularly on the equity side, that if the stock market goes back up, the manager of this stock market group of securities, it's also going to go back up. So you're not saying, oh my God, I sold that at this price. I could have got so much more now. Well, it's in there, pal. This one's going up too, and you can take your profit. And profits, and I know you're going to ask me this next about profits. The single most deadly mistake that investors make over the course of a lifetime is not taking their profits. If you just said in your blurb in your you say you woke up and you were 50. In those 50 years, you've had the COVID mini crash. You had the dot-com bubble and 60 and 87. Yeah, and you were in 87. The market crash 87. You probably weren't really heavily invested at that time, but maybe you were. But in all those three occasions, you can think back and say, my portfolio value was here. And by the time that October 19th was done, it was here,
Yeah.
30% lower or some such
Yeah.
silly number. And you didn't take your profits. Because if you had taken your profits and sold and reinvested slowly and only reinvested an amount, it talks about how you invest during rallies versus what you do during corrections. But that's it. If you had taken your profits and reinvested slowly in each of those occasions, because one thing for sure, there's never been a rally that hasn't succumbed to a correction, and there's never been a correction that hasn't succumbed to the next rally. That's called the market cycle, which is another chapter in the book that you'll get to, that talks about recognizing and respecting the market cycle. It's there. There's nothing you can do about it.
Right.
There's nothing any of those guys talking on TV can do about it. If it's up, it's going to go down. If it's down, it's going to go up again. Even irrespective of wars, famines, pandemics, election results, et cetera, et cetera, et cetera. It's going to go one way or the other. We don't know which, but if it's up, we're going to prepare for it to go down. If it's down, we're going to get ready for it to go up. And we're going to have rules. We're going to have what I call targeted profit-taking rules for whatever scenario we happen to be in. And it's so easy to determine what scenario you're in. Really, I mean, there's so much technical data out there that you can look at, and you don't even have to go head over heels looking at. All you have to do is look at a chart of the S&P 500, and you can tell if we're in an upcycle or a down cycle or where we are, and adjust your investment strategies accordingly.
Their stock starts to go up and they just think it's always going to go up.
Can be no love in investing.
That's right.
You have to love your profits. In my methodology, I don't sell out of hate. Most people sell out of hate. I sell out of love. I love the fact that I made money on this. And you know what? I'm going to do it again.
Yeah.
I mean, when I was younger and I was dealing primarily in equities, I must have taken profits on Pepsi 100 times, Coke, Exxon, Chevron. I mean, you name it, they all go up. Go out when you get done with this podcast. Go look at a couple historical charts from any of those wonderful companies, not not the high flyers that don't today's stars that don't pay any dividends, but the old steadfast companies that you all know, the household names, and look at their charts. They all went up and down. Yeah.
And if you
And
bought them on the
it's
right day.
yeah. And the same thing, you never know what that right day is. That's the
I
problem.
know.
If somebody could tell me, you know, what's the market going to do tomorrow, I could be a very wealthy man. You have to use the information that you have and not necessarily focus. I guess that's the last thing, or one of the other things. Don't make market value be the first thing you look at when you look at your monthly statement. Look at the income you're producing. And on a quarterly basis, you should want that income to be going up. If I look at mine, because different things pay their dividends on different months, and if you have a properly diversified portfolio, the amount of income each month's going to be different. So compare March to June to September, or January to April to July, and look at that. And every quarter, you should see your income increasing. Every year, your income should be increasing. And I'm not going to talk about working capital because I don't think we have enough time to get into that. But back to the book, The Retirement Money Secrets.
Retirement money
You'll
secrets.
learn about that. You'll learn to look at how much is the intrinsic value of my portfolio as opposed to the market value. And that's a differential. If you start thinking like that, you'll sleep nights, even when you know the market's been down 500 points.
So,
So
Steve, where can people buy the book?
it's at Amazon, it's at Barnes and Noble, it's at the various places you can go for ebooks. There's a couple different shops. It's pretty much available everywhere.
So, Steve, our time is just flying away. What is it? Is there anything that you wish I would have asked you that I haven't asked you, or anything you want to make sure people know? Anything you want to leave people
I
with?
think
Yeah.
the thing about that distinction we just made between market value and the intrinsic value, and taking your profits and focusing on your income. The only other thing that you have to be sure of, no matter how you invest or who you invest with, is that you make sure you only buy quality securities. And there are ways, which I outline in the book, to identify a quality security, not just a quality closed-end funds, but quality securities as well. And there are ways to do that too. And I did not focus on individual securities, but my prior book talked about individual equities, how you can distinguish the quality of those. And you can get in the website, you can get my first book for free. That was called The Brainwashing of the American Investor. The book Wall Street does not want you to read. And you can get that book for free
Awesome.
at my
That's
website.
very generous, Steve. Thank you.
Okay.
All
Any
right.
questions that you have that?
You've just done a fantastic job of covering the differences and the interest, when we should do this, what we should do. I think we have a roadmap, and then we just need to get the book so we can make sure that we can implement our roadmap in the correct fashion, and then we'll be set.
I enjoyed the conversation.
Thank you, Steve. Me too. And
Thank you.
thank you, listener, for listening. Think about if you know anybody who might ever like to retire, and forward this episode to them so that they can also benefit from Steve's wisdom. And in the meantime, have a fantastic week.